mutual funds, na?
Yes, sir.
So I will just show that slide. So today, of course, the plan is to go for equity investments and that sort of thing. And I just hope that we have Paresh ji should be coming in, and Tanya, any news?
No, sir.
Nothing. Okay, let's just put a message to these people on the WhatsApp group. There's another thing now which we have been doing more than a month now. Every Saturday we are having a quiz on one of the units. So far we have covered, I think, units 1, 2, 3, and 4 also, I think. And now
I attended some of the sessions.
You attended some, did you?
Yes.
Okay. And so we have been continuing that process now. That we are continuing to hold those quizzes. So for the quiz for this week will be tomorrow, and you will see that in the WhatsApp group I have shared the PPTs for insurance.
Yes, I got.
So that I hope both of you have downloaded that, and so tomorrow's quiz will be on that insurance part. We'll continue with that, and so let me just, since Alice is here, before anybody else comes, let me just try to share something on the mutual funds part, which we had done last, so that. So Alice, this is specifically for you, so that you get for Shruti, of course, it will be revision, a very quick revision of what we covered in the last 4 hours, more or less. So the first thing to remember in a mutual fund is that this is the way it actually works. There is a sponsor, there is a trustee, and this trustee is actually there is an arm's length relationship between the sponsor and the trustee. So if, let's say, we go here and we look at this, you get a better idea. So let's say that Tata Mutual Fund is the sponsor, and Tata Mutual Fund wants to start, an asset management company. So what it does is, it will start the company, but this company is going to be looked after by Tata Trustee Company Private Limited. And Tata Sons and Tata Investment, which is the sponsor, they will not actually be taking any decisions with regard to this company. So between the sponsor and the trustee, there is a arm's length relationship. There is a distance. So that the Tata Sons cannot influence, these people. These people will take their decisions in accordance with the objectives of the AMC and will protect the interests of the investors. So this was one point. The other point which we had made was that there are so many funds that it is a little difficult to choose, which fund I should actually take, and which one actually suits me, and things like that. The advantages, of course, are very clear. You get the benefit of putting your money in the hands of a fund manager who is very experienced. There is diversification, you have liquidity. So you get the benefit of expertise, you get the benefit of diversification. So those are the main advantages there. And the disadvantage, of course, is this, that it is difficult to actually choose which fund to go for. That is one. I had shown you the performance of a number of these funds over a 6-month period. And we had also looked at length, at the website of one of the mutual fund industry as a whole, Money Control. And we had looked at exactly how different funds in each of the categories are performing. So this was one. Then we understood the terms asset under management. So mutual funds may have investments in 40, 50 companies, and they manage these assets. And that total amount which they are managing, which is spread across these various companies, that is basically your assets under management. And we looked at NAV, and we basically said that NAV is the total asset value net of expenses per unit of the fund, and is calculated by the AMC at the end of every business day. In a simple manner of speaking, this AMC is this NAV is basically the price of one single unit of the fund. So this was one. How do we calculate it? We take the total assets, including the current assets. We reduce the current liabilities. Whatever amount is left, we divide that by the number of mutual fund units. So you get your net asset value per unit. Then we spoke about the expense ratio. So the various expenses which the fund has. And this is basically this expense which the fund has. This is spread across all the units. And everybody who invests in these funds will basically have to, that expense is there for you. So when you invest in a mutual fund, in return for the expert advice that you're getting from the fund manager, in return for the benefit of diversification that you have. Tanya, welcome. You're slightly late today.
Good evening, sir. Sorry, sir.
So we are just revising what we did last time, the mutual fund chapter. Okay. And this was the expense ratio. And then we spoke about these different types of mutual funds. And in fact, most of the discussion which took place last time was with regard to the different types of mutual funds. We looked at their performance, their portfolios, their NAVs, and the size of the assets under management. We looked at all that. And most of the class was essentially about looking at these things practically and seeing exactly how these different funds are functioning. Now, we have open-ended funds, which they basically keep functioning. Investors come, they stay for a while, then they sell their units and they go off. They're replaced by other investors, but the mutual fund continues. So there are many funds like that, which have been there for a very long time. Then you have, of course, close-ended funds, which have a fixed maturity period. It could be from 1 to 7 years. And these funds are there. They tend to have stable funds, and not surprisingly, their returns are pretty good. Then you have a direct mutual fund plan where the investor invests directly with the mutual fund company by passing all distributors. So if you're very clear about which exact fund you want to invest in, which plan you want, which scheme you want, then this is good, because you will save yourself the amount of commission or fees which the mutual fund charges. Or if you're not so sure about these things, then of course you would go for a regular mutual fund plan. And here you would be investing through a distributor. So obviously there will be a certain charge. And then we looked at these different types of funds: equity funds, debt funds, hybrid funds, solution-oriented schemes, all this. And basically, the rest of the presentation is about this aspect. So we will not be able to look at them all today, obviously. We had, I think, just reached, we had, I think, finished. Did we reach, can anyone recall, Shruti or Tanya, did we do this part? I think we had done this. The basic point to remember here is that, these solution-oriented schemes, and I had showed you on the site also, that these schemes are there. Please note one thing: every single fund that I have mentioned here, these funds are there. These types of funds are there. and you will be able to actually invest in any of these different types of funds. If you click on the relevant tab on that site, you will find that there is a children's fund category, and within that children's fund category, there will be different schemes which are listed, schemes of different, let's say, like different sponsors. It could be HDFC, it could be Tata, ICICI, ICICI Pru, any of them. There are retirement funds, children funds. These schemes are essentially a way of marketing the fund. The basic nature of the fund or where it invests, that does not actually change. It is like, it is giving you a very clear idea about, about what to choose. Like, for example, if you take this, it will be easy for you to make a choice. You are thinking in terms of securing the, let's say, the educational future of your children. So what you can do is you go and put the money in a children's fund. They will take it and they will invest it in probably in equity. And then after 5 years or more, whenever you feel you need the funds back, you can go and take it back. See, another thing which we found that day when we were looking at funds was that most of these funds tend to give you very good returns when you go beyond 3 years. Up till 1 year, the things tend to be a little low. I think all the funds were in green. That is, they were showing some profit. You were not losing on the initial investment. But at the same time, the problem was that it was sometimes as low as the rate you will get in a bank. And remember, when we compare with a bank, we are comparing the mutual fund, where there is a very clear market risk, with an investment in a bank where there is no risk. That is a fixed income instrument. Whatever the bank promises you, that you will get. So if you are getting a return in the mutual fund which is equal to that of the return in the bank, basically it means that you are losing, because you are taking a risk and you are not getting a compensation for the risk that you are taking. So that is one point. Then we spoke about index funds. These index funds, in my opinion, are one of the best bets that you can actually invest in. It is one of the very safe funds. They tend to be over a long period. They tend to be very profitable. All were in double digits. If you remember, last week we looked at the performance of different index funds, and I myself was so taken up with the returns that I have also started a small investment in an index fund. So, I found that this is something which is quite consistent in giving good returns. What does an index fund do? Can anyone remember what it does? Shruti, Tanya, anyone? The answer is there on the slide. You just have to express it properly. Shruti?
Sir, they are the similar returns as that per index.
Not returns, Tanya. Basically, what they do is, see, the index like Sensex or Nifty 50, what they are doing is, the index is composed of a large number of shares of big companies mostly. And so when we say Nifty 50, the Nifty 50 is based on the shares of 50 companies.
Yes,
So what this index fund will do is, it will invest in the same 50 companies in the same proportion as the Nifty index is formed. Like suppose Nifty 50 has, let's say that HDFC is one of the companies in Nifty 50, and let's say it has 5% in HDFC, and let's say it has 4% in SBI, and then let's say it has another in Asian Paints, it has 3%. Then the index fund will also do the same thing. They will again have 5% in HDFC. They will have that 4% in FBI, in SBI, and they will have the same 3% in Asian Paints. So it will track the fund. It will track the index fund by investing in the same shares in the same proportion. So in that way, if the index is moving, if Nifty is moving up, then logically the returns in this particular mutual fund will also move in the same direction and to the same extent. That is the meaning of this index fund. So these index funds are also known as tracker funds. They track the index.
Excuse me,
Yes, yes.
sir. Actually, one very silly question, sir. Actually, sir, the whatever money we pay to bank, जो भी हम deposit करते हैं, जो हमको interest मिलता है से, तो how bank promises us to give a good amount, मतलब एक reasonable amount like 6% हमको मिलना ही है वापस. वो बैंक को कैसे
वो बैंक को ऐसे मिलता है. We have a section on banks in this course also, Tanya. So we'll be discussing this in more detail. But the short answer to your question is...
Actually, you told this, but sir, I was absent that day, I think.
No, I'll tell you again. It's a very simple thing. The bank, what does the bank do with money? See, the bank takes money from from lakhs of people. Some people give it fixed deposits. Some people give it saving funds. Some will give it current accounts. So let's say that what is the cost of the bank for these funds? It is the interest that it pays. So like you're saying, I'm assured of 6%. So 6% is, let's say, the highest cost for the bank. On certain categories of accounts, like for example, in a saving fund account, it will be paying only 3%. So the saving fund account that you have, you're only getting around 3%. PNB today has reduced it to 2.75%. If a businessman has a current account with a bank, then in that case, the bank does not even have to pay him interest. So let's say that the average cost of the bank is 5%. If I make an average, I find that the bank's average cost is 5%. Now, what the bank has to do is, it takes this money and it will give loans. And when it gives loans, it just has to make sure that it earns more than 5%. So if it can earn more than 5%.
Excuse me, sir. Confusion. Sir, actually this question I have asked to Papa also. Sir, sir, तो फिर अगर कोई बैंक अगर लोन किसी कम इंटरेस्ट पे दे रही है और कोई पैसा सेव कर रहा है उसको ज्यादा इंटरेस्ट दे रही है, सर, तो ये पॉसिबल हो सकता है?
अगर बैंक ऐसा करेगी तो फिर उस घाटे का सौदा है ना.
Exactly, sir. Sir, how will bank make profit?
हाँ, लेकिन ऐसा होता नहीं है. Bank never does this.
Yes, sir. I'm asking to you, sir. Is it possible?
No, it's not possible. If a bank ever does this, it simply means that the bank will not be able to function for a very long time. The bank will always have to give the loan at a rate which is higher than its cost. It is like, the question you are asking is, it is very similar to, suppose there is a shopkeeper who is buying something at 5 rupees. Can he sell it at 4? If he sells at 4, then his business will close in a little while. So that is the answer to your question. Now, index funds, I hope Shruti, Alice, all of you have understood this. And then we come to this concept of gold ETFs, exchange traded funds. So basically, a gold ETF, what it does is, it allows you to invest in gold without physically holding gold. So basically what happens is that each unit, when the fund starts, what it will do is, it will price the unit as equal to a price of gold, of 1 gram of gold. So whatever is the cost of 1 gram of gold, that will be the NAV for the fund. Plus, of course, a bit of charges in. Now, as the price of gold moves up or down, the NAV will also move up and down. So basically what happens is, when you invest in a gold ETF, what you are doing is you are investing in practical terms in gold. You are investing in gold, and you are able to, you are investing in gold, and you are saved the trouble of storage, storing the gold or anything like that. So it's quite easy that way. And in this particular case, the taxes also are low, so it's good for you in that way. So this is another, product which is available in mutual funds of buying gold and continuing with that. So this particular thing is this is more or less, this is the only slide I think which I had not covered last time. So this sort of brings us to the end of this section on. Paresh ji has also come, and I will stop sharing this slide, and now we can start with the today's presentation. In fact, Paresh ji, you have only missed the revision of the mutual fund section, which we were doing. So I thought we had just revised that. So you have not missed anything new. You were there all throughout the mutual fund presentation. So that part is okay.
Okay, sir.
Now what we will of course do is, we will start off with the equity part. Now, when we speak about equity, the interesting thing here is that, see, from the point of view of an individual, with little background in finance, investment experience, there are some very basic truths. आप कुछ ऐसे लोगों के बारे में सोचिए जिनको कि जो लेमैन है फाइनेंस में और जो इन्वेस्टिंग कभी किए नहीं, ज्यादातर लोग ऐसे ही होते हैं. तो फॉर मोस्ट पीपल इन्वेस्टिंग का क्या मतलब होता है? यू टेक योर मनी, यू पुट इट इन अ बैंक फिक्स डिपॉजिट. अच्छा, बैंक फिक्स डिपॉजिट में फॉर एग्जांपल तानिया's question was about the rates of interest, how a bank manages to ensure that it is able to pay the whatever is the quoted rate of interest that it is offering. Now the interesting thing here is that we put money in the bank, we get a fixed return. In the process, we do not get any idea about market risk. Market risk kya cheez hai, that we don't understand if we are only investing in a bank, because we are used to one simple fact: whatever the bank is quoting, whatever they are saying they will give us, that they will give. So tomorrow, if a mutual fund comes and they say, sir, in the past we have given a return of 12%, please invest with us. So when you begin to think about this, should I invest, should I not invest in this mutual fund, you will think the bank gives me this, this fixed income. I'm investing in a mutual fund. Most probably these chaps will also give me that same sort of return. If they are promising it, they will give. But then when we invest in the mutual fund, ultimately, because people tell us that, look, शेयर्स और शेयर्स क्या होता है, किस तरह से इन्वेस्ट किया जाता है शेयर्स में, ये आपको समझ में नहीं आता है, इसलिए ऐसा करो, आप म्यूचुअल फंड में इन्वेस्ट कर लो. सो यू गो एंड इन्वेस्ट इन अ म्यूचुअल फंड, एंड समटाइम्स व्हाट हैपेंस इज दैट you get unlucky, or the mutual fund manager makes bad decisions, and then you end up getting a very low return. In some cases, you may even find that you will get back less than what you had invested if you if you take the money out, especially in short periods of time, 1 year, 2 years, like that. But in the process, what happens is that you learn about market risk. And in my opinion, if, with small sums of money, if you get hurt a little in investing, and in the process, if you learn about how, what's unreliable the market can be, then that is, in a way, it is good for you. Because then when you come and you begin investing in equity, you should take that lesson that equity में पैसा बनेगा हर हालत में. This is not at all true. It is very possible that you will not earn in equity. See, the basic thing is when you invest in something, you should understand the instrument properly. So when I'm investing in a debt instrument, like a bank fixed deposit or a company bond, there I understand very clearly that this is a fixed income instrument. That means there is a commitment by the bank or the issuer of the bond, the company, that they will give me back my money plus the quoted rate of interest, whatever they have said, they will pay me that amount. But when I go and put my money in equity, the first thing to remember is that this may not happen. Nobody is giving any guarantees. Nobody is saying that we pay dividends in the for the last 10 years, we have been paying dividends of 15%. We are going to do that again this time. That will not, nobody says this. The other thing to always remember in equity is that there is no guarantee that there is no way of selling that back to the company. You will always be selling your share in the secondary market. You go to the secondary market, that means the share market, capital market, and you will sell your share there. And when you sell your share there, at that point of time, it is going to depend to a large extent on what the prevailing share price is. So if you hear, stories of people making money in the stock markets, and you think of it as, as something which is very easy, something which you can do and you can make money in the quick, in the short term, the first thing to learn is take that out of your mind. Because there is no easy way of making money on the stock markets. In fact, there is no way of making money in the stock markets in the short term. Please, I'm underlining or putting emphasis on that last word. In the short term. In the long term, yes, you can make money, but that requires discipline. It requires patience. So these are some of the things which you have to get into your mind before we begin discussing this equity part. So like I say, we should always start with this very common sense proposition that before putting money in any financial asset, please understand the financial asset. Only then do you begin to think about investing in any financial asset, whether it's a mutual fund, whether it is a share, whether it is debt, whether it is gold, whatever it is, the first step is to first try to understand. Now, with that background, let me ask the first question. So what is equity? Anybody? Simple answer. And the related question is, why is there a need for equity? Anyone? Simple question, nobody wants to answer? At least something?
Sir,
Yes, sir.
so equity is like owner's capital.
Equity is like owner's capital. Okay, so you are basically thinking of the balance sheet and what you find there. And okay, equity refers to ownership. That is correct. Now, yes, Tanya.
So equity is a kind of ownership of assets, with having debts and liabilities.
Right. The last part, I think you have.
Equity is the ownership of the company.
Equity is the ownership of the company. Okay, so that's another way of looking at it. Basically, when we say equity, now we are talking in terms of ownership. Now, in the context of this, when we say equity share, we will be saying So the ownership of the share. Now let's think of it this way. Why are there, why is there a capital market, and why do we have equity shares in that market? Why does it exist? For example, when you say that why does a bank exist? Why does a bank offer fixed deposits? The answer would be that yes, they need funds to give loans. So they take money from you by way of deposits. They give you a certain amount of interest, and then with that money they give loans and they make money. Now, in a similar fashion, why do we have a capital market where shares are sold? Why do we have equity? What is the logic?
A company issues equity when it has to raise money from investors or the normal public, so that it can even expand or for new projections. And in return, they give dividends for that and are part of ownership.
Okay, very, very good, Shruti. Huh? So basically, if I look at it from even a macro level, I can say that, for the economy to actually function, there has to be productive activity. People need so many things to simply go on with their lives. You need clothes, you need food, you need transport. There's so many things. Every single thing all around you has to be produced by someone. Now, when it has to be produced, it implies that a whole manufacturing process has to be put in place before anything can be produced. Now, how do we do that? For that, we need money. Now, initially, that money may come from, let's say, a small group of people who are starting the company. They can start whatever manufacturing process they want on a small scale. They go ahead with that. And then after a little while, as soon as they want to expand, they find that they need more money. And when they need more money, they go for an initial public offering. That means they offer shares of their company to the public. And then the public begins to buy those shares. And in the process, where does all this take place? Which market does this take place in? This is the share market. And this is generally known as the capital market. So remember last time we also distinguished between capital markets and money market, where we said that money market is different from the capital market because this is about wholesale money and with extreme liquidity, where the players in that money market are the bankers, RBI, big companies, public sector undertakings, things like that. But in the share market, the capital market, it is people like you and me and bigger investors who actually buy and sell shares here. So that was one part. Now, the next part is, why does the share price go up or down? So once we have bought shares, let's say the company issued shares at let's say 15 rupees per share. Now, when we look at the share market prices, we see that sometimes the share price is going up, sometimes the share price is going down. Why does that happen? Anyone?
Demand and supply plays a major role in that. As the demand of a share increases due to its performance or any reason, the share prices go up and vice versa.
Okay, so that is correct. Everyone, I think, has understood what Shruti said, that it is essentially demand and supply. Now, see, in the normal, in the case of commodities, let's say like food grain, when we say demand and supply, both demand and supply can move up and down. That means the stock of food grain in the market, if there is a very good harvest, let's say the stock of wheat in the market goes up, so the supply goes up. The demand, let's say, stays the same. So since supply has gone up, demand has remained the same, we would expect that the price will come down a little. But remember, in the share market, the supply is more or less fixed because the company shares have been issued. Unless the company goes for a new issue, which doesn't happen very frequently, you will find that the supply of shares is fixed. So basically what matters is demand. So if Shruti says that if the performance of the company is good, then there will be a demand. Now, broadly speaking, this is correct. But there is one more point out here. Many times you will find when you look at different at the share market and you look at the prices of companies, you will find sometimes that the share prices are going up for companies which in fact are not doing so well. And the share prices keep going up, and it is hard to understand what has happened there that has made the share price actually go up. And so there is one more factor in play. See, everything being equal, in a perfect world, a company which performs the best should have the best price also. But actually, you will find that this is not the case. Quite often, companies which do not perform so well still end up having a fairly okay share price. So, this creates a bit of a problem for the investor, because it is not, the relationship between performance and price is not one-to-one. Some other factor is coming in. Can anyone, say anything about that other factor other than performance? Paresh ji, anything? Alice? Paresh ji, tell me.
Sir, I may not explain correctly, but people involved, this broker and shareholders, they create demand, artificial demand in market. Sometimes it also happens.
Okay, no, that
is they can set a trend.
That what you're saying, Paresh ji, is actually a manipulation.
Manipulation, yeah.
Where you are trying to basically build up the image of a company so that people begin to buy the shares, and as they begin to buy the shares, the price goes up, and then when the price goes up, the persons who had actually done this manipulation, what they do very nicely is they sell the shares.
Yeah.
So I think last time Tanya had very casually referred to this word pump and dump. If you remember, Tanya?
Yeah, correct, sir. Pump
and dump. So this is pump and dump. So pump and dump basically means that you are doing something for the purpose. That's why it's illegal. Recently, some brokers have been actually penalized by SEBI for this. So what they had done was, they had created this wrong feeling among investors that some companies are actually going to do very well. Before they created this impression, they had bought the large chunks of shares of that company. They created this whole, this image of this company shares going to do very well and things like that. Lots and lots of people began to buy. The share prices went up. See, demand and supply concept. And as the share prices went up, they dumped their shares and made a lot of money. So, but when I say that there is another factor, actually, I was referring to something which is not related to manipulation. See, basically, जब आप शेयर खरीदते हैं तो आप इस उम्मीद में खरीदते हैं कि इसकी कीमत बढ़ जाएगी आने वाले दिनों. You have this in mind. It is in your mind, that perception is there. That for whatever reason, you may have read good things about the future of that company. You may feel that that particular industry is doing well. For example, there is a company called Wabag. This company, basically, one of my colleagues here who is into this a lot, he does very serious analysis of companies. He came and said that everybody should buy shares in Wabag. This was about 1 year ago. So I said, why? He said the reason is that they are dealing in a commodity which today is gradually becoming more and more important. They are dealing in water. So purification of water and supply of water. He says, in my opinion, this is something which is so fundamental. The requirement of water is so fundamental that there is no reason why the prices of this particular share will not go up. Okay. So he made this based on his perception that since this company is into a commodity which is strategically very important, which is almost essential, not almost, which is essential, there are very few people, very few competitors. Therefore, this company is going to do very well. Now, this is a perception which he had. On the basis of his recommendation, I think most of us here, we bought some shares of that company. Now, the sad thing is that we never have too much money. So the number of shares we bought were also, of course, very limited. But the share price since then has gone up by more than 30-40%. And is continuing to go up. Now, this is just perception. It is a calculated guess, no doubt, but it is a perception on the part of people that yes, it is going to do well. Or for example, you take this feeling, take this other perception. The government comes out with this particular policy in each budget that we will raise money by selling public sector enterprises. So Air India was sold last year to Tatas. Okay. Now, this year, once again, they say that we are going to raise a lot of money by selling some of the different public sector units, but they have not mentioned which. Now, they also say that we will try to reduce the number of banks by selling some of the public sector banks to the public and privatizing those banks. Now, the moment you say this, some people will begin to now figure, yes, which are the banks which will be sold. And then somebody may say that, okay, Bank of Maharashtra is there. There is a chance that this might be sold. Someone else may say that Canara Bank is there. This might be sold. And because this is so long not part of one of the bigger groups of banks. As you know that there was a consolidation in the banking sector and many of these banks were grouped together. And like, for example, Corporation Bank was grouped together with Punjab National Bank. All the state bank subsidiaries were grouped together with SBI. So similarly, somebody may say that Bank of Maharashtra, Canara Bank, this is not part of any of the, the bank groups right now. So maybe this is going to be sold. So let's buy this, shares of this company. The day it is sold and it comes under private ownership, because of the fact that you expect the bank to do better. You see, it's only in your mind. You expect the bank to do better under private ownership. Therefore, the performance will improve. And when the performance improves, the public will want to buy shares and therefore the share prices will rise. This is a perception in your mind. Now, based on that perception, that umeed jo aapke man mein hai, you will now buy this particular share. So this, what I mentioned to you, this word is referred to as perceived value. That means the value of this particular company and therefore its share will be high in the days to come. आने वाले दिनों में ये अच्छा होगा, ये मेरे मन में ठीक है, उसके पीछे कारण है ऐसा सोचने का, that is there will always be a reason. But ultimately, it is not based on financials. It is based on perception. So that is one other reason why share prices go up or down. So there may be a perception that this company will not do well. It will fail absolutely. In which case, you will begin to sell its share. So this is another thing to always remember in the share market, that everything is not based on performance. If you get very unlucky, then you can become the victim of manipulation. And in some cases, this perceived, not in some, in all cases, this perception in the minds of the public, that again is very, very important. Now, has anyone thought of what the size of this market is? Is it in lakhs? Is it in crores? The number of investors who are there in the share market? Can you think how many investors, new investors, joined or let's say began trading on the stock market for the first time in the financial year 2021? That means ending March 21. During that period, how many new investors joined the share market? Any guesses, anyone?
It's around 1 crore or something. I've read it on news, but I don't remember the exact value.
You're coming close. You're coming close. Anybody else wants to guess? See, it is 1.5 crores. 1.5 new retail investors joined the investment community. That is, they began to trade on the stock market for the first time in the financial year 2021. Now, this is in 1 year. If you take all the people who are there today with demat accounts, with trading accounts, who are actually trading on the stock market, people like you and me, it is going to be many, many crores. Now, all these people who are trading there, each of them has the ability to take a decision on his or her perception. So you can never predict. So how many of these people are going to buy which share, going to sell which share? It is absolutely unpredictable. And this is why we say that everything in the stock market, in the capital market, is subject to market risk. This is the risk. The risk is that people will decide, will feel that the future of some company or the other is bad, and the share prices will come down. And if that happens, then you will lose. That is the risk. And there is no way of predicting this. So there are any number of theories, any number of tools which are there, but nobody so far has come out with anything which is close to accurate. If somebody had done that, then obviously that person would have, become hugely wealthy. And as more and more people came to know about it, in effect, it would have nullified itself and it would not have worked. So the question which we come to at the end is investing in equity always risky? The answer is yes. But there is one particular point here. It also depends on the time of investment. How long are you going to keep your money in the stock market? See, the longer you keep your money in the stock market, you can say that to a large extent that the risk is reduced by that particular time. Your chances of losing your money or your chances of not making a decent return comfortably over the bank rate, whatever the bank is offering, is very less. You are going to make that money if you are able to show the patience to keep your money there for a long period of time. The other thing to remember always is that it also depends on when you buy that particular share. If you are thinking in terms of making money in the long term, then at least try to buy the share when the price is relatively low. See, remember, the prices of shares keep going up and down. And the thing is that when the price, actually tell me one thing, when will the prices of shares be coming down? Anyone? When will the prices of shares be coming down?
When most people start selling it.
When most people start selling it. And when will they begin? When will the prices of shares begin to go up?
When people will buy.
When people will buy. Now, the question is that if you want to make money, you will have to act in the exact reverse direction. So when everybody is selling and the prices are coming down, you have to have the discipline to enter the market at that time. And that is very difficult. So for example, soon after COVID in March 20, some of the best companies, the share prices of some of the best companies began to go down. Now, as they began to go down, since this is a subject I have taught, it occurred to me that this is the best time to actually invest. But finding the courage to do it was very difficult. One thing was very clear, that when everybody is selling, you should not sell. I think this is pretty clear. No? If everybody is selling, prices are going down, then don't sell. See, the rule in making money is sell when prices are high, buy when prices are low. And when our price is low, when other people are selling. So if you are going to sell when everybody else is selling and buy when everybody else is buying, then effectively what will you do? You will buy when prices are high and you will sell when prices are low. And the biggest problem in share market is this, is your own particular sense of discipline and the fact that all of us tend to be influenced by what others are doing. That is what is also referred to as herd behavior. जो सब कोई कर रहा है, हम भी वही करते हैं. But in the concept of demand and supply, जो सब कर रहा है वो demand को particular direction में ले जा रहा है. It's either reducing demand or it's increasing demand. If it's increasing demand, the share prices are rising. If it is reducing demand, then the share prices are falling. If you walk with the crowd here, you will be definitely getting into a situation where you will be in a loss. So this point is something to remember whenever you go. So it requires a lot of patience and a lot of discipline. And this is why it is the exact opposite of debt. See, in the case of debt, once you have bought the particular instrument, if you have bought a bond, you after that are sitting quietly at home. You know that your bond will pay you a certain amount of interest. And when the time for redemption comes, the entire amount of the bond will be paid back to you. So you don't have any worries. But in the case of the share market, you are going to have to be very, very careful that you do not become the victim of herd behavior. And with that, with this preliminary thing about the share market, I think we can now think in terms of going to my little presentation on this and starting with that. So since we have already reached 6:56, what I'll do is we'll take a short 5-minute break and then start with the presentation. And we'll start with exactly how a company comes into being and floats an ITO and an IPO, and how things actually begin to move. We take some very simple way of valuing the company, and then we'll proceed with that and go ahead. So I think this is the right time. So we can all take a short break of 5-6 minutes, and then we'll be back. So it's roughly 6:56. We'll be back by, let's say, 2 or 3 past 7. Huh? Okay.
Okay.
Okay, fine.
Okay.
Okay, we've lost Tanya again. Tanya, I'm sure will be coming back soon. So we're all here, na? Everyone is here?
Yes, sir.
Yes.
Yes, Paresh.
Yes.
Yes, Alice. So let me just get the presentation and just a minute. Okay, so let's start with. So we discussed about what equity is. Let's just take a standard definition. I've taken this straight from Investopedia on the net. So equity represents the value that would be returned to a company's shareholders if all of the assets were liquidated and all of the company's debts were paid off. That means you go to the balance sheet and whatever assets the company has, if you sell all those assets, you'll get something. And from that, if you are able to pay off all your debts, all your current liabilities, all the long-term borrowings that you made, you pay it all off. Whatever is left, you own that. As a company, you own that amount of money. And that is your equity. Now, each individual shareholder owns a little extent of that. Whatever amount is there, a certain part of that, depending on the number of shares that the investor has put in, he owns that part. So that becomes his equity, his ownership of the company. And the other thing in this context, which you should always remember, is that a share will not be redeemed by a company unless there is a buyback or something. Otherwise, the share will always be sold in the secondary market. Let's keep those, those initial thoughts in mind. Tanya has also, I think, joined us now. And with that in mind, we will start with the first thing. Now, what I'm saying here is that we are starting, Ramesh and Mahesh, they've decided to start a company. Okay. And they each put rupees 5 lakh to start this company. Why what I'm basically trying to show you is from the point of starting the company to the point where the company needs shares and floats an offer in the stock market. I just want to take you to that point so you can visualize this whole process. And in the process, you also look at how that share price was arrived at, that first share price. Okay, so Ramesh and Mahesh, two people, they want to start a company. They have 5 lakh rupees each and they start. So when they start, let's say they start in 18, we are just taking this little thing here just to show you. So Ramesh puts in 5 lakh. This is capital. Mahesh also puts in 5 lakhs. So the company gets total of 10 lakhs. Now the price per share. Now the thing is, remember the company is legally a separate entity. It's a separate legal entity from Mahesh as an individual or from Ramesh as an individual. These are, in the eyes of law, they are two different people. Now, when they start this company, what they can only hold equity in that company. They can hold shares in that company. Now, how much shares will they hold? They decide that the face value of a share will be rupees 10. And since they have contributed 5 lakhs, therefore the number of shares which each of them will hold will be 50,000. So total we have 1 lakh shares and each of them has 50,000 shares. Is this part clear to everyone?
Yes, sir.
Okay. Now, next, let's say that we do very well. Whatever business we are in, we do fantastically well, and we make a profit of 10 crores. Now, if we make a profit of 10 crores, then that means the profit or earning, this profit in the context of, when we speak, when we look at words in the stock market, you will not find the word profit. The word profit is generally replaced by a word called earnings. So then earnings per share is 1,000. Because how do I calculate that? So this is the year 2020 now. Capital 10 lakhs. Price per share was 10. You made a profit of 10 crores. So that will come into your reserves. So earning per share is basically now 1,000. Are you getting this, everyone? So think of it like this. You have 1 lakh shares and this 10 crores can also be thought of as 1,000 lakhs. Therefore, your earning per share is 1,000 times. So you are getting 1,000 times the price of the share. Therefore, the earning per share is 1,000. The net worth of the company will obviously be 10.10 crores. Everybody with me up till now?
Yes, sir.
Okay.
Yes, sir.
Now you come to the next time. Now these people are thinking, Ramesh and Mahesh, that we have done quite well. Our company has a good business model, obviously. It's doing well. We have earned so much of profits. Maybe the time has come to expand. And now to expand, we need to sell shares to the public. Now, if you want to sell shares to the public, you will have to, you can't sell, at, so the right now, each share has a huge value. So it will be very difficult for you to sell like that. But and the first step obviously is you have to get the company value. So you will say that the net worth of the company is 10.10 crores. Should I simply treat this as the value of the company? So remember, this 10.10 crores is the net worth of the company. But the value of the company as a going concern in the days to come, this company is going to function for a long period in the future, hopefully. Now, if somebody is going to invest in that, will you say that the value of the company is only 10 crores? 10 crores is for you because you are the people who first made that initial investment. You took that risk of starting the company. You took the risk of going into that particular business and you were able to earn this money. Now, when you're selling to someone, obviously you want to sell at a higher price. So the first thing is you want to value it. So you consult some maybe investment bankers. They have a look at your company and they say, look, your company is going to do pretty well in the future. So let's at least think in terms of 15 times of whatever your earnings are. So if your earnings are, let's say, 10 crores, we should think of valuing the company at 15 times of this. Why 15 times? Because basically what you're saying is that over the years, this company's value is going to be at least this. It will be much more than this. So if you are going to buy today, you should actually be thinking about that value. So earnings 20 crores, value of the company, PE ratio is 15, price to earnings. Price to earnings is 15. Therefore, the value of the company is 150 crores. Number of shares is 1 lakh. Price per share becomes 15,000 per share. Are you getting this, everyone? You have approached someone, let's say an investment banker, to value your company. They say that your net worth is 10 crores, but in your company has the capacity over its life to generate much, much more than this. So let us assume 15 times of your current earnings. Over the years, you will earn much more than this, but let us take 15. Because right now you are able to get an earning per share of 1,000. So they are saying we will only take 15. Let's take 15 and let us get it started on that model. So they say that the price as a proportion of your earnings will be 15. So if the ratio is 15, the earnings are 10, then price into earnings is 150. See, this is a basic thing. Please understand this. There are 2 or 3 things which are coming here. Number one, the value of the company is a perceived value. It is something which you are saying will happen. It is there in the future. It is not there today. It is not there today. If you look at the net worth of this company, it is only 10 crores. But I am telling you that in the days to come, this company is going to generate a lot of wealth. Therefore, because it has a business model in place, which will allow it to keep earning money. And when I think about value, I'm talking about all that earning power which this company has in the years ahead. I'm trying to put a number to that earning power. जितना पैसा ये कमा सकता है आने वाले दिन में, उन सबको हम एक बार ले लेते हैं. And I begin to think, yes, 150 करोड़ तो कम से कम ये कमा ही लेगा. अगले 10 साल में, yes, they are going to do this. Therefore, let us price it at 150 crores or 15 times of whatever was the earning. The earning was 10 crores. We are saying 15 times, so we will price it at. Now you may say that why 15, why not 14? This is ultimately a judgment call on your part. If you price it too high, then maybe it will be difficult for you to sell the share tomorrow. If you price it too low, then you will lose because people would have bought for 150. You are making it less than that, you are losing. Are you getting the basic concept here, all of you?
सर लेस में लोग क्यों नहीं खरीदेंगे?
हाँ,
सर जब प्राइसेस लेस हो जाएगी तो उसमें
नहीं, लोग तो खरीदेंगे लेकिन आपको तो कम मिलेगा ना.
एग्जैक्टली.
So you don't want to make it less, and if you make it more और लोग नहीं खरीदते हैं, then also you will fail because तब लोग खरीदेंगे ही नहीं. Then you won't get any money. See, remember, everything that you sell, that money is coming to your company. If you make it less only for the sake of selling the share, then you will lose money ना. आपके पास में potential था 150 लेने का, लेकिन आपने 140 में बेच दिया. So in that particular case, what is happening? You are actually losing. That is my point. So you have to take a calculated risk. What is the amount that the public is willing to pay? So you will be giving them this story that we started 2 years ago with only 10 lakhs and today we are 10 crores. So we have grown 1,000 times. So this company can really do well. So when we are asking you for only 15 times of our earning capacity, in fact, we are doing you a favor. We are actually doing you a favor. So you do this. So one thing I want you to keep in mind is this value that we speak of is an arbitrary figure. ये एक judgment का figure है. ये ऊपर नीचे कुछ भी हो सकता था. We decided that this was the figure because we feel that the public will accept this figure and they will buy shares at this rate. Does this make sense to all of you? Very quiet, all of you. Alice,
Yes.
any questions? Anything you want to say about this?
Yes, sir.
Paresh ji,
Sir.
No, sir. No, sir.
you are getting the point, na? And Shruti?
Yes, sir.
Okay. Now, you want to go for that IPO. We already said that you are valued at this, this particular thing. Now, the problem is, if you go for an IPO and you say that the price per share is 15,000, it will not work. Na? Nobody is going to actually buy at 15,000 because then the price will be so high that you will get very few investors. So you have to bring down the price. How do you do that? So what you do is, there is this concept of giving yourself a bonus. So what you are saying is that for every one share that I own, I will allot myself 99 shares. See, remember, there are only two shareholders, na, Ramesh and Mahesh. Whatever they decide, that will happen. Company unki hai, or shares bhi unke haath mein hai. So they will decide what to do. So they say that for every one share that we have, we will take 99 times that shares. Kya hoga? Share price kam jaye. So for example, Ramesh has 50,000 shares. If you do 99 times of 50,000 shares, what will you get? You will get 49,50,000. तो इसको बोनस शेयर रमेश को मिल गया 49,50,000. टोटल शेयर्स कितने हैं? 4950 प्लस 50 lakhs. ये हो गया रमेश का हिस्सा. एंड द सेम थिंग हैपेंस विद महेश. महेश के पास में भी 50,000 था. ही गेव हिमसेल्फ 99 टाइम्स. वो दोनों मिला के इतना हो गया. टोटल both of them now, instead of having 50,000 shares each, now they have 50 lakh shares each. Now, in return, what will happen? The amount of money which the net worth of the company is not changing. Now, wo to abhi bhi wahi hai, 10. So how will they do that? What they will do is, they will say that this 50 plus 50, the value of the company is 150 crores. Sorry, not net worth. The value is 150 crores. The number of shares is 50 lakh plus 50 lakh. So I have basically 1 crore shares. Therefore, the price per share is 150. Just look at this calculation and see if it makes sense to you. So the price per share before the bonus was 15,000. Now, what we did was, we gave ourselves a bonus. We decided to give ourselves a bonus. Now, when we gave ourselves a bonus, what we did was, we divided our shares, we took our shares, and we found out the value of each share in terms of the valuation made of our company. Now, the valuation of our company was 150 crores. We gave ourselves, the total number of shares we increased to 1 crore. So according to the new valuation, what we really have now is, we have a value per share of rupees 150. Now with 150 as the value per share, we are in a position to go for the IPO. And now we will go for that IPO. And when people buy this 150, if it goes successfully, then all this money will flow into the company, and the actual net worth will also increase because of that. Now see, so the company wants to go for an IPO of 60 crores. So what they will do is, they will issue 40 lakh shares. So they will issue 40 lakh shares at the rate of 150 each. 60 everybody, let's say it is fully subscribed. The investors buy these shares. The company gets 60 crores of equity capital. Initially, the actual money which the company had was 10. Now they get 60 more. And in the process, they are able to expand the company with this cash. This is actual cash now. See, the valuation which we had, this 150 crores, this was something which we were hoping that the company will do in the future. That is not actual money. But now what we have done is, at that rate, we have sold 40 lakh shares to the public. So by doing that, what we have done is we have actually generated money. And this is the share that people buy in an IPO. So when an IPO happens, and when you have that pricing, this is something like, this is what actually happens. A valuation of the company is made. The valuation of the company is based on what the company will actually earn in the days to come. On that basis, a valuation is made. On that basis, the price of the share is fixed. And on that basis, the actual IPO is floated, the offer is made, and then people buy that and they get the money. Is this clear to everyone?
Yes, sir.
So basically, when we say, equity market share, I just want you to keep this particular story in mind, this Ramesh and company story. This is how it happens. This is one way of looking at it, one simple example. Broadly speaking, every company will be doing this. Okay? So this is the starting point. Now, here, we had a look at, we saw that one way of valuing the company. How did we value this company? We valued it by saying that the price should be at least 15 times of the earnings. And on that basis, so this was a way of valuation. Now, suppose we try to understand this whole concept, this price to earning ratio, PE ratio. So this is something which, if you actually begin to invest in the stock markets, you will find that you will keep coming across this word, this PE ratio, price to earnings. Now here, price to earnings per share, price per share to earnings per share. So how will I do this? First of all, I'll get my total earnings. I'll divide by my total number of shares. So once I do that, I have earning per share. So the profits are divided by the number of shares. So what is the share profit per share or earning per share? I get that. And then let's say a company has an EPS of 10. And we see that it can maintain a growth of 15% each year. So basically what I'm saying is that if this company can grow at 15% each year, then I am saying that the PE, the price should also be 15 times. This is just what shall I say? It's like a back of the envelope calculation. So we're saying that the price should also be 15 times of this particular, of the earning, of the EPS. Now, why should anyone do what is, if a person invests at this rate, if you're telling someone that the PE ratio is 15 and he actually invests in your company and he buys those shares, what will he get actually? So it's something like this. Let's say that the profit is 10, growth rate is 15. So in year 2, the growth amount will be 10 plus 15% of 10, 1150. So in the year which you invested, the profit of the company was 10 rupees per share. Now 15% is the growth. So next year it will be 1150 per share. In the year coming, it's going to be 13 rupees 23 per share. So you keep finding out 15% for each year, and you keep this whole thing. At the end of it all, after 10 years, what is the amount that you're getting back? You're getting back 203.04 rupees. So your investment was 150. After 10 years, you have got back 53 rupees more. Or should you feel, is this all that you will get, or will you get something else? Let's say that this amount every year you got as dividend. Let's just suppose that this amount was distributed to you as a dividend. So on your investment of 150 rupees, you were able to get this amount of 203 in a period of 15 years. So roughly you are making around 3.5%. You have got that. What else will you get?
Dividend?
Now, let's say this is the dividend. This is the dividend which you got, Pareshji.
Okay.
Every year they gave you this money. Let's say they took the profit and they distributed 100% payout. They distributed this money to the shareholders. So at the end of 10 years, you have ended up with 203 rupees. But there is one other gain which is going to come, one very big gain. That gain is the capital appreciation. See, in these 10 years, because the company is steadily giving 15%, more and more people will perceive value in the company. बहुत लोग ऐसे होंगे मार्केट में जो कहेंगे कि भाई ये कंपनी तो बहुत अच्छा काम कर रही है, ये 15% हर साल दे देती है अपने शेयर होल्डर्स को, तो क्यों ना हम भी इसमें इन्वेस्ट करें. And as more and more demand is created for the share of this company, what will happen is that the share prices are going to go up. And as the price goes up, if at any point you want to sell this company, then what will happen is you will end up with much more than that 150 which you had actually done. On the basis of a growth rate of 15%, the calculation is that the share price in 10 years of a company which is giving 15% growth rate will be how much? Can you imagine? What will it be like? It was 150. It gave 15% every year. After 10 years, that growth is likely to be almost 520 rupees. So basically, you are getting 3 times of your capital, plus you are getting your dividends. So when we say that, the PE ratio is a good, thought when you want to invest, think of the PE ratio, and you can make this the basis of your investment decision. This is the logic. So if you are choosing companies which are in a very steady, revenue space, and you rely on PE ratio, what the mathematical calculation behind that recommending a PE ratio as a good way of finding a good investment is this: that you, in a good PE ratio, the profit keeps growing. If the profit keeps growing, what Shruti was saying in the beginning, if the performance is good, then the share prices are like the demand should increase. So the classic scenario is PE ratio is good, growth is good, PE ratio good, growth good. Therefore, the company is going to do well. Therefore, there will be a demand. Therefore, I am going to earn not only by way of dividends, but I will also earn because of the increase in the price of the share. This is the logic behind PE ratio. So in 10 years, I have got back 203, and the price of the share has also appreciated to, like we said, more than 3 times. So at the end of it all, I end up with a very good investment. Now, the point is, can we always rely on PE ratio? The answer to that is that no, you can't always rely on PE ratio, because there are a number of sectors where the what shall I say, the industry is considered to be cyclical. So what will happen is that, let's say this is the normal situation. The share price is, let's say, not very high, not very low, it's somewhere here. Then share prices begin to go up. It goes up, there is a boom. And you have this huge increase in share prices. The commodity, let's say, is something which is doing very, very well. And then after some time, people's confidence in that, let's say the demand for that commodity goes, people's confidence in that industry, that goes. And then, there is a bust. That means it goes, it's not doing well at all. So the share prices will go down hugely. And then gradually it will come back to normalcy. Then after some time, again, there will be this boom. Again, people will see value in that industry. Again, prices will keep increasing. Now, if you look at these industries, steel, petrochemicals, tires, sugar, you will find that it follows a cycle. Now, if the industry is following a cycle, that means that the growth will not be like that, 15% or 16% or 20% every year. That means maybe it will have 2 years of good growth. That 2 years may be really good. Maybe it will be 20, 30%. And then it is going to have 4 years of bad growth or another 2 years of bad growth, then followed by another 2 years of good growth. So it will keep going. The cycle will keep feeding itself. It will go up. Then after some time, it will come to normalcy. Then it will go down. Again, normalcy. Then it will go up again. So it will keep moving like that in circles. In an industry of this type, you cannot think of P ratio as a way of actually, making P ratio the basis for your, let's say, decision to buy the company share. Take this example. 2006, the steel industry is doing very well. Prices are good. Tata Steel is doing very well. And Tata begins to think that I should actually begin to expand across the world. So there is this big company, Chorus. And Paresh ji, I'm sure, will remember that period. And Tata decides to buy Chorus. Tata buys Chorus. It has problems with the unions in Chorus. It ends up paying a very, very high price also for Chorus. See, because the steel industry was in a boom, the share prices were also high. So Tata ended up paying a huge price for Chorus. And then after some time, the industry is cyclical, the steel prices began to fall. And this was the period when China was stepping up its capacity in steel. They were supplying a lot of cheap steel to the world. The result is that the price began to fall. And once the price began to fall, suddenly Tata found that this whole investment was not so good. They were not being able to earn any money. It took 10 years for Tata to the share price to come back to where it was. It dropped very low. Tata had a huge problem with managing the debt which it had taken. It had taken loans to buy Chorus. So there was a huge problem in trying to pay that back. Their share prices were at rock bottom. 10 years of bad, they had a bad time before coming back. Now, if you're going to look at Tata Steel's PE ratio in 2006 and decide to invest in Tata Steel on that basis, look what will happen. Because the industry itself is not a stable industry. Any industry which is cyclical in nature, there this PA ratio will not work. What I am also trying to give you an idea is that all industries are different in nature. There are different types of industries. So when we make investments, we should be aware of these different types of industries. So the next thing we will look at is that. But have you people understood what I am saying here, all of you? 2 points I've made. Now, one, I have said something about PE ratio. And in the last slide, I was trying to explain to you that PE ratio can be one way of valuing a company. How do I understand how valuable the company is? So I can say, okay, fine. I will consider the earnings which the company has. And I will say that I will look at the price. And wherever I find that the price is 10, 15 times the earnings, I will say that, yes, this is a good buy. I can actually think of buying this. Remember one thing here, price is an external factor. Earnings is internal to the company. The company can do something to make its earnings increase. But the price is something the company does not decide. The price is something which the market decides. Therefore, when we combine P and E, price and earnings, price and profit, we are looking at two things, one internal, one external. One thing is in the control of the company. the profit part, the earnings part. The price part is not in its control. That is there that perception comes in. Those companies which are thought to do, by the public as being good for the future, as having a good future, those are the companies that people will demand. Those shares people will demand, and those share prices are going to rise. So this was one point I made. The second point I made is that all companies cannot be bought on the basis of just PE ratio, because they are cyclical in nature. So in a particular year, they may be having an excellent PE ratio, and in some other year, you will find that it has gone down and it is not doing well at all. So these are the two things I'm making here. This also tells you that there are different types of industries. Okay. Everyone is very quiet. Are you following this, all of you?
Excuse me, sir.
Yes.
Yes. Tanya, tell me.
You told about that booming, that steel is booming, the concept. Sir, I didn't understand.
Boom means that there is a huge, whatever product they are making. Let's say that steel is there. Tata is making steel. Now, steel is sold not just in India, it is sold across the world. Now, let's say that the world prices of steel are going high. It is increasing. So if the steel price is increasing and my cost remains the same, then what will happen? I will make more profit. So as I make more profit, what will happen is that people will feel that this particular company is doing very well because it is right now being able to sell a lot of its product, which is steel, at a very high price. Therefore, this company is doing so well, let's buy the shares of this company. And so there will be a demand. And as more and more people begin to buy the shares of this steel company, what will happen is that the share prices will go up very high. This going very high is referred to as a boom. This is what I'm saying. Did you understand, Tanya?
So, why it is called booming? So, because the share prices are high, we will have profit.
No, boom is a positive word.
Okay, sir.
Boom is a positive word. Bust is the negative word.
Okay.
Boom means to do very well, to do excellently well. That is why.
Understanding that booming means putting down.
No. It's not like that. I thought you were aware of this. Okay, it's my mistake. So boom is when a company does very well. It's referred to, even when we say there is an economic boom, what are we saying? That the economy is doing very well. That's all. Okay, so this is one. Then we come to the next part here. So classifying stocks. So remember this whole cyclical thing and PE ratio and all that. What we were trying to say basically is that there are different types of companies. So let's take the first type. So let's say that you have a concept of blue chip stocks. So what are blue chip stocks? This is again a word which you will become very familiar with if you begin to sort of read about equity investing into that. So blue chip stocks will be stocks of well-established companies. So let's say that companies which are there for a very long time, which are doing very well. So these companies are considered to be safe. Why are they considered safe? Because their business model seems to be working. Whatever business they are in, it seems to be doing well. Not doing well in 1 year or 2 years, but maybe they've been around for 30, 40 years, and this company, the business is doing well. There is a steady growth in its revenues. Its profits are increasing. It is also, let's say, a company which is paying regular dividends. It has been good to its shareholders. As a result of that, the general perception in the minds of people will be that these are good stocks to buy. Everyone clear on this? So this is known as a blue chip stock. Why the word blue? This is there. You just accept it. This is the way it was thought of. If this blue is a positive category, this is there. So blue chip stocks. Everyone clear on this?
Yes, sir.
Okay. Then there is a category called income stocks. Now, income stocks basically are stocks of companies which are paying pretty good dividends. If they're paying good dividends, normally it means that they have a steady source of income, a predictable source of income. Let's say there is a company which is selling power, just as an example. Let's say it's a power company. It is, in a business which there is a constant demand for power. People are always buying. They are constantly getting revenues from the sales of the power. As a result of that, they are able to pass on some of the profits that they make to the public. So utility companies, power, water, telecom, if they are doing well, are basically their stocks would be classified as income stocks. So what does this tell you? If you are looking for steady dividends, then maybe you should be looking at income stocks. That's one. Then there are growth stocks. So these are companies which have the potential to give you the highest growth. So remember, growth, whenever we say, is something which is in the future. So when we said PE ratio of 15 times, and we said, how did we justify that 15? So we were saying that there is a potential in the future. So similarly, when we say growth stocks, what we are saying is that there is something that this company has which is going to help it to become much, much bigger in the future. It has something, its sales are going to increase. As a result of that, its profits will increase. It will do well, therefore its share prices will rise. So these are stocks which can give me a good return in the future. It also means that in the short run, it will not be so good. If I am expecting that there is going to be a sudden rise in the price and I'll make money by buying this growth stock, no. The idea is that I stay with the investment for some time, allow the company to do its business, allow the company to show good performance, to grow, and it will give me a good return as a result of that. Okay, then you look at the next one. This is the stock which we just discussed. So automobiles, steel, cement, heavy industries. So whenever there is good economic growth, these sectors will tend to do well. So if there is good economic growth, Tanya, economic boom, that word boom can also be used for good growth. What will happen is that it means that more industries are there. There is more industrial growth, which also means that more people are, getting jobs, that the purchasing power in the economy is increasing. Because of that, what will happen is the sales of goods will increase. So let's say that more people will take housing loans and buy houses. If more people buy houses, there is going to be a demand for steel. There is going to be a demand for cement. Many more people will want to buy vehicles, two-wheelers, four-wheelers, etc. So the demand for automobiles is likely to go up. So if there is an economic boom, some industries are going to be, let's say they will ride with the boom. They will do very well. और कुछ ऐसे इंडस्ट्रीज होंगे जिन पर कोई खास प्रभाव नहीं पड़ेगा, जैसे FMCG, basically fast moving consumer goods, all the goods that you can think of which you get in, let's say, a Reliance outlet anywhere, or any of the retail stores which you have, you go there. Those are goods which will sell in any case. Food grains are going to sell, sauces and jams and everything that you can think of there, your toothpaste and soaps and detergents, they will always sell, economic boom or no economic boom. So those industries tend to be a little steady. But if you take these industries, automobiles, steel, heavy industries, these tend to do better when there is an economic boom. And since banks also give lots of loans to these industries, because these industries are capital intensive, इनको खड़ा करने के लिए बहुत पैसा लगता है, so they have to borrow also. So in that case, what happens is, because of that, these companies will, the banks will also tend to do better in times of economic boom, not so well when things are not going too well for these companies, because then these companies are, they find difficulty in repaying the loans that they have already taken. The bank will not be able to find so many borrowers to take loans from them. And then it will be difficult for the bank to make money. So when the bank's performance goes down, chances are that its share prices will also tend to go down. So banks which make a lot of money from corporate loans, that means giving loans to big companies, will be affected more than banks which give loans to, let's say, smaller people. But in any case, banks should also be thought of as cyclical. So are you people getting an idea of this? These different types of industries and how, the stocks that you buy, you should be thinking about this also. What type of stock am I actually buying? Is the industry cyclical? Is the industry stable? And is this company paying dividend or not? All these things. Any questions, anyone?
No, sir.
Alice, anything?
No, sir, clear.
Then next we come to, and then defensive stocks remain stable during declines in the economy. So remember one thing, some of these now will be in many categories. So you may find that there are growth stocks also in the blue chip category, defensive stocks also in the blue chip category. Things like that are there. There could be defensive stocks in the income category. So FMCGs, I think, are good examples of this. So they would tend to remain stable even when the economy is declining. Okay. Now, the next thing that we have will be basically, so what should our strategy be? We will, of course, look at this in greater detail tomorrow, but broadly speaking, let me try to take you through two concepts. So what should our strategy be? That means, how do we decide when to buy and what should be the basis for our decision to buy the share of a company? This is one question which now will always be there when we are thinking in terms of investing. So what should be the basis of our decision? So one particular view says that look at the financials of the company. So companies which do well, which are performing well, which are financially stable, which do not have excessive debt, which have good revenues, look at them. And those are the things which will ultimately ensure that the company is going to do well in the future or not so well in the future. So company with good financials, good fundamentals, that is what fundamental means out there. The actual, the financial performance of the company, this company is going to do well. So if I can do an excellent analysis of the financials, then I am in a position to say, yes, this company has excellent financial performance. Therefore, I should actually go for this company. Now, this is called fundamental analysis. This concept of looking at financials. What fundamental analysis is this? This is quantitative fundamental analysis, because quantitative means numbers. So I'm looking at numbers. I'm looking at the balance sheet. I'm looking at the cash flow statement, the income statement. Everything is a number ultimately. So when I'm looking at that, I'm just trying to see, is this company really doing well? Is it making profit? Is it, does it have too many debtors? How exactly is the health of this company? If I see it's actually doing well year to year, and obviously I'm not looking at one balance sheet, I'm looking at balance sheets for the last 5 to 10 years. And I'm trying to see what the growth pattern is. So for example, if you go to Money Control and you look at any particular company and you go to its financials, so maybe next time we'll do this, and you look there, you will find a huge amount of information about the key financial parameters of that company. So what is the amount of equity that it had? If you look over a 10-year period, you will begin to see if the company has actually increased its equity capital or not. Have they issued more shares, or is it exactly stable? You'll be able to see how the reserves have increased. Reserves, remember, are the profits which were not distributed as dividends, whatever was retained by the company. So you'll be able to see that again. Have the reserves actually increased from over the last 10 years? If it is increasing, that's a good sign. The company is doing pretty well, that means. Then you'll also be able to look at other things like the debtors. So there are people who have bought goods from the company, but who have not paid the company. We refer to them as debtors. So these debtors who are there, from whom the company has to collect money, is this increasing over the years, or is it stable? Is it going down? So if you find that yes, it is stable or it is going down, you can say that yes, this company has a fairly, let's say, its credit policy is good. People who buy on credit from this company are returning that money. So if you begin to look at those things, and on that basis, if you begin to decide whether the company is financially healthy or not, you are basically doing fundamental analysis. And what type of fundamental analysis? Quantitative fundamental analysis. So quantitative approach uses the company's financial data to understand the underlying value of the company. This is one thing which you remember. This is the simplest way to do it. If the analysis shows that the company is likely to do well in the coming years, this becomes a reason to invest in the company. So this is the first thing. The second aspect would be, if we look at the qualitative approach. Now, the qualitative approach is different. Qualitative means I am looking at things which are not about numbers. I'm looking at different things. So, for example, what is the business model of this company? Kya karta hai? What does it sell? And whatever it sells, this particular thing, does it have a future? So what does the company do to earn profits? So ultimately, to earn profits, the company will have to sell something. And it will have to sell something, produce that something at a lower cost, sell it at a higher cost. When will people buy that particular commodity which the company is selling? When that commodity is something which is relevant. So if you look, in the past, you will find that there are many companies which gradually became irrelevant. So, for example, one of the famous examples which is there is of Kodak film. So Kodak used to make film in a period when the concept of digital photography hadn't come. Today, whenever we want to take photos on our phone, we are thinking in terms of how much memory space the phone has. So if the phone has memory, then I can take a photo, it will be stored. But there was a time when photos were taken manually and that was stored in a film. Now, the business model of Kodak was to basically make cameras and to make film. So this film which they made, as the whole technology moved ahead, they were unable to move ahead with the technology. So its business model suddenly became irrelevant. Nobody was willing to buy those things. So the company disappeared. So when I say business model, I'm saying that we are thinking in terms of what does the company do? Whatever it does, is it relevant today? Will it have a future or not? So first thing to remember there. More recently, you can think in terms of what happened with Nokia. So when Android came, mobile phones all switched to Android. The system which Nokia had, that really didn't work. And as a result of that, Nokia got out of business. Finally, they had to make a change. They tried that Windows approach. That also didn't work out so well. So finally, they have been trying to get into Android. But what I'm saying is, when the business model itself comes into question, then the qualitative approach tells you that whatever is the fundamental analysis here, this cannot go on for too long, because this company is in a business which is not going to survive in the future. The second is, what is the competitive advantage of the company? ऐसी क्या खास बात है इस कंपनी में जो औरों में नहीं? कौन सी ऐसी चीज है जो ये करता है which others don't do? So I'll leave you with this thought here today, and what we will do is we'll pick up this discussion tomorrow at this point, but we'll do that after we finish the little quiz that we have for tomorrow, and that quiz will be on that unit on insurance. So I have put the PPTs on the WhatsApp group. I hope all of you have seen it. So just have a look at those PPTs. I'll prepare a short quiz, and we'll start tomorrow with a short quiz on insurance, and then we'll continue with this discussion on how to analyze, fundamental analysis, technical analysis, that sort of thing. So that's it from my side for today. Any questions, anyone?
No, sir.
No, sir.
All of you have been very quiet today. I was hoping for more of a discussion today, but tomorrow I hope you people will be a little more active.
Yes, sir. For that discussion, we need to see this today's classes video twice. Then only we'll be able to understand.
Okay, ठीक है. Okay, that's a defensive answer. ठीक है, Shruti. We hope you all have a look at this, and then we'll start tomorrow again. Okay, ठीक.